Meantime, shares of Airbnb and Roku are both up double digits right now in the teens here in overtime after reporting earnings moments ago. Joining us now is Evercore ISI head of internet research, Mark Mahaney. Mark, two big moves. Maybe give me Airbnb first and then tell me how Roku's results here fit into the content ecosystem.
So Airbnb put up stronger than expected numbers, very similar to what Expedia gave you. And I think other travel companies are going to tell you the December quarter was pretty robust when it came to travel. And so far, 2025 is shaping up to be more of the same. The other kind of positive surprise for investors, one of the fears I had going into the print was that the company was really going to start investing aggressively in 2025, and we were really going to get a reset down to the margins. We're getting a reset, but it's very modest. It's nice to have a high margin business like they have so they can put an incremental 200 to 300 million into some of their newer initiatives. I think they're going to be bringing back experiences aggressively, and but they can do that and still maintain what are some of the highest margins I see out there in the sector. So the overall results in Airbnb, the stock's up. Stock should be up.
And Roku?
Roku, this is a little bit of a tale of two cities. We had this disastrous print from Trade Desk yesterday that kind of made you wonder about all ad platforms outside of Meta, maybe, and Google and maybe Amazon. And so there was concern, fear going into Roku tonight. But Roku put up a beat and raise quarter. It looked pretty clean. Their gross margins, the profitability levels are continuing to improve. I think there's a lot of struggles, a lot of almost structural challenges that Roku faces going forwards. But this was a quarter in which there was a lot of fear going into the print, and they overcame it. So that the bar was low, they rose above it.
So, Mark, what does it take for Roku to get to sustainable profitability?
Oh, probably a lot more scale and maybe a sizing down of the devices business that they have. Yeah, it's a good question. I mean, we're still dealing with EBITDA. It would be nice to get to GAAP earnings. I don't think they've got the scale to get there. Maybe sustainable, high, large, chunky GAAP earnings. I don't think they have the scale to get there for a few more years. But that's what you'd probably need. Just scale, and then trying to find some of these areas to win down from or to thin down from. And devices would probably be the best area to thin down out.
One of the most fascinating things coming out of this earnings season to me, and we saw it again today with Airbnb, is the fact that we had a leap day last year, and we've also had some pretty substantial FX headwinds, and that's really hit companies across industries this earnings period. And yet, a lot of these two factors were not necessarily factored into street consensus. And I wonder where you think it goes from here and what needs to be kept in mind now with the earnings that we're still waiting on.
Well, Morgan, I think people are going to start looking ahead. And so if the worst quarter of the year with the most headwinds because of leap day and maybe the timing of Easter, which is key, actually, for travel names, and then, of course, currency, and a lot of these the internet names that I look at, the large cap ones, have 50% of their revenue from overseas. I mean, you've got the real strong headwinds in this quarter, which means if you look forward, you should start seeing potentially acceleration in Q2, Q3, Q4. And generally investors like that. And if you get acceleration, you usually get margin expansion with it. So the question is, could you get beyond the March quarter? And it's been a bit of a hiccup for some of these names. There's been very few names that have aggressively traded up unless they had something really idiosyncratic like Meta, Spotify, Netflix. Most of the other names have been kind of cautious with their March quarter outlook. As long as it wasn't too bad, it almost seems like the market is saying, okay, we get through March, the rest of the year should be good.